I think the important thing is the underlying thematics that drive what's happening within individual REIT asset classes. And there, I think there's a tale of many cities. There are obviously some REITs that are in sectors where there are very strong macro tailwinds, and others in sectors where the macro tailwinds may be less visible, maybe even some potential moderate headwinds. Although I can't really think of any sector in the REIT space now that is facing significant structural headwinds.
Can you describe the macro backdrop you see for REITs and commercial real estate today? And to what extent do you expect current trends to continue?
Yeah, Dan, I think the macro backdrop is quite favorable for REITs at large. You have central bank policy causing interest rates to come down, which is beneficial. You have a generally growing and fairly resilient economy in the United States. And those are important to any corporate and certainly to our REIT sector at large. I think the important thing is the underlying thematics that drive what's happening within individual REIT asset classes. And there, I think there's a tale of many cities. There are obviously some REITs that are in sectors where there are very strong macro tailwinds, and others in sectors where the macro tailwinds may be less visible, maybe even some potential moderate headwinds. Although I can't really think of any sector in the REIT space now that is facing significant structural headwinds. I think it's more of a degree of how much tailwinds they're benefiting from. So one extreme that gets talked about a lot, obviously, is digital infrastructure and what's happening with respect to that type of real estate / asset class benefiting from the AI theme. And there's obviously a lot of talk around the benefits and the valuations associated with companies in that space in the REIT sector. Similarly, although unrelatedly, there's some pretty strong tailwinds in the senior living space, given aging demographics, limited supply, et cetera. So there are some sectors within the REIT space where their version of macro looks very positive, and there are others where their version of macro in their sector is not necessarily negative, but not necessarily as positive either.
And how would you assess the type and pace of M&A activity in the REIT space this year? And where do you think things are headed in 2026?
I mean, it's a good question. It's one that investment bankers are always trying to prognosticate about, and we tend to be glass half full because our business obviously is quite dependent on REITs wanting to pursue various kinds of transaction activity. I think M&A, as distinct from the transaction market where assets are traded, whether it's sold by REITs or acquired by REITs, M&A, which generally tends to involve entities that are bought or sold, has been, I would say, at historically lower levels than what we've seen in prior cycles. That is generally, I think, a function of the fact that many REITs are trading at discounts to net asset value, but not at sufficient enough discounts to warrant either private or other buyers to show up and pay a fulsome price. So I think we've seen a little bit of stagnation from a traditional M&A perspective. Having said that, what I've been observing is that REITs are getting more creative in terms of how they think about M&A. They're looking overseas, and I think in the healthcare REIT space in particular, whether it's skilled nursing, senior living, or otherwise, there's been a fair amount of activity where US REITs have been investing in companies overseas, primarily in Canada and in Europe. We've seen it in even where a REIT is potentially being sold, that it's not necessarily getting sold to one buyer. Maybe that one buyer is buying a significant amount of the REIT, and then the balance of it is a liquidation of the remaining assets, so that that buyer is able to pay the best price possible for the assets they want and not have to discount the assets that don't fit their strategy. So I think we're seeing different ways in which REITs are pursuing M&A or willing to have M&A pursued upon them to the extent that they're the seller, which makes it much more interesting in some ways relative to the traditional model, which was generally, you're a REIT and you're going to merge with another REIT, buy another REIT, or be taken private.
And what do you think will be the hallmarks of REIT capital strategy and allocation in the coming year?
Yeah, I think REITs have become pretty disciplined in terms of how they think about raising capital, and many of them have been very good in terms of capital allocation as it relates to managing the right-hand side of their balance sheet. They're not looking to take on excessive leverage. They're equity funding investments or acquisitions appropriately. They're generally pacing their acquisitions based on their cost of capital. Generally speaking, I expect that to continue. There always may be an outlier here or there, but generally I think REIT management teams are pretty disciplined. I do think, interestingly, many REITs, particularly some of the larger ones, are trying to figure out alternate forms of capital, whether it's private funds that are either closed-end or open-end, or joint venture partners that can provide them capital, where they can optimize sources of capital so that the source of capital is not only limited to raising public equity or public debt. They can also look at opportunities where they can raise money from these other sources that then enables them to take advantage of two things. One is their platform and their know-how and their access to deal flow. They can find and underwrite the right opportunities and put it into the right pocket, if you will, because certain assets may not fit the balance sheet, but they may fit one of these other vehicles that they're sponsoring. And two, it enables them to actually pursue transactions even if the cost of capital on the public balance sheet isn't at that given moment in time particularly attractive because of what's happening in the public equity markets or otherwise. So it gives them a variety of ways to appropriately find investments and match those investments with the right cost of capital without being solely reliant on the balance sheet. And I expect that team to continue into, frankly, into 2026 and beyond.